Hello and welcome to Trading Hour live from the CNBC-TV18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always Hormis Fatakia and Reema Tendulkar. It's a Friday, so happy Friday first up, guys. Finally, the week is ending, but it's going to be a long day. But nevertheless, for the Nifty right now, we are seeing some stress come by. So Nifty is at the lows of the day as we speak. Of 170-point cut is what we are looking at right now. It's actually further accelerated, so it's almost a 200-point cut right now. It's the private banking index which is putting some pressure. Financials overall are not doing so well. We had Axis Bank's results which were reported yesterday. We'll discuss that in greater detail. For now, of course, that is one stock which is putting some pressure right now. And all the sectoral indices, they are in the red right now, barring Nifty Media. But yes, major pressure coming in from across the board. So we'll be watching out for whether this pressure continues or not. Wipro, though, is doing well after the numbers that the company reported. Reema, of course, will analyze those numbers in greater detail. We'll get the management commentary as well. But all in all, the start has been on the back foot. We'll have to see whether that continues through the day or not, because we do have a lot of earnings trigger which will come by.
Three big ones, right? Post-market hours. So Reliance, ICICI, HDFC Bank. So that will set the tone for Monday. So it's a big week in terms of, the next 12 hours is going to be big in terms of earnings, 24 hours. By the way, for the Nifty, we've breached the 25,000 mark as the Nifty is down 170 points at the day's low right now. Sensex is below the 82,000 mark, 600 points lower. Benchmark indices in percentage terms have dropped close to about 0.6%. And I think this is the lowest level. For the first, we breached the 25,000 mark for the first time in about a month.
Yeah, 24th of June was the last day when we did that. And yeah, three stocks, a third of the Nifty in the next 12 hours. So important results that are lined up as well for the Nifty going forward. And 165 points down. As of now, we started today's trading session just 40 points down for the week. There was still some hope that the weakness in Axis Bank could be offset by some of the other names, but unfortunately that's not been the case. Axis Bank, though, is still holding on to losses of around 4.5%, but Wipro on the flip side, though, is doing fairly well for itself in today's session. There are some of the stocks that are bucking the trend in today's session. Saregama is one of them, 6% higher on that stock. They announced some content acquisition yesterday, and so a good move on that stock today. Motherson Sumi Wiring is the other one, not Samvardhana Motherson Sumi Wiring, the demerged entity, 44 rupees on that stock, 3% higher there. The stock trading ex bonus today is yet to adjust for it. So that's the adjustment for the bonus issue. Anand Rathi Wealth is the other one. Anand Rathi Wealth is the top performer on the Nifty 500 this week, is up 20% this week, so 2.25% higher, strong results, and is building on to those gains. So a lot of stock specific action in today's session, as well as has been the case all through the week, as the index has been consolidating and now it's seen one big down move towards the close of the week. But the stock in focus, though, has been Axis Bank, and the results have been much talked about all through last evening and this morning as well. It was a disappointing quarter. Asset quality deteriorated, profits that dragged profits, and provisions were high, slippages were high. Gaurav is here with the fine print of that. Gaurav.
When it comes to Axis Bank number, we saw a weakness, and this was specifically because of the asset quality. So let's understand the numbers first. First disappointment was in net interest margins. Now they declined almost by 17 basis points on a quarter-on-quarter basis. Bank has suggested that 4 basis points was basically because of the interest rate reversal, and that is the reason they have attributed this 4 basis point to this and 13 basis point to repricing. Another disappointment, the big one, is the asset quality. Now what they have done is that they have actually changed their provisioning norms. They have actually made it more stringent, and as a result, profitability impact was somewhere in the range of 620 crore rupees. So let's understand these numbers as well. Because of these stringent provisioning policies, provisioning increased almost by 800 crore rupees in this quarter. Other than that, gross slippages came at around 8,200 crores. Now, if we exclude this provisioning and the technical impact, the gross slippages would have been at around 5,900 crores. Now, that is another impact, and as a result, we saw credit cost and slippage ratio specifically increasing sharply. Now, because of this, when we talk about the ROAs and ROEs, these ratios were also impacted. ROAs got impacted almost in the range of 15 basis point, and we saw ROA impact of 1.4%. So definitely what was disappointing is that these provisioning, the stringent provisioning norms are actually taking a toll on balance sheet. on the back of this, now management is saying is that slippages are likely to come down because now the recoveries will come, and that is the reason for the quarters coming ahead, slippages will be muted, and because of the recoveries, credit costs will come down. On the other hand, loan book growth was at around 8%, and now management believes that this will actually pick up. They believe that Axis Bank can actually grow at a pace higher than the industry. So that is something which was optimistic commentary from the management. But overall, in terms of number, weakness is what we saw. And as a result, we are also seeing some weakness in the share price as well.
Okay, yes, 4% lower on Axis Bank. Thank you for explaining that to us, Gaurav. In fact, the management in the conference call said that they are confident about growing faster than the industry, and also they spoke about technical impact. Listen in to what they had to say.
NPA classification happens on days past due criteria, and then there is qualitative criteria which is agnostic of days past due. We have not changed any day past due parameters because they are driven by regulation. The qualitative parameters, as we have previously indicated, we benchmark to most prudent in market on an annual basis. That benchmarking exercise happens for us in the period of Feb and March, and the implementation of that happens from the next fiscal. The purpose of the benchmarking is to make sure that our balance sheet is resilient and can withstand any credit cycle that comes our way, therefore giving you a robust, credible outcome when growth comes back. So roughly, if you look at what we do is quarter 1 and quarter 3 are cyclical, and the way I would request you to think about it is in quarter 1 and quarter 3, about 25% or thereabouts of slippages are from the agri portfolio. So you could apply the maths to 5,400 crores, and roughly about 25% or thereabouts would be agri. The percentage would be broadly similar for last year's rupee crore number. The rest of the 75% is coming entirely from the unsecured business. We are very clear in making a call out saying we do not see stress in the secured part of our retail book as on date.
When Rajiv retires in August, as per expectations of RBI, we need to have MD, CEO and 3 EDs. Our NRC is actively looking at who and when we appoint a third person as executive director of the bank. When we're ready to do that, we'll be very happy to do it, but you should expect announcement of ED appointment as Rajiv retires. So that's the answer to one of your questions. Second question, I thought I answered in detail in the response to the first question, which was, yes, credit growth is where it is, but our confidence about what we can do the rest of the year and in the medium term, given where our platform is high. We are expecting to grow faster than the industry. I mean, obviously that's an expectation, but we are quite driven towards ensuring that we can deliver that output.
The management there of Axis Bank after their quarterly results, of course, there were a lot of things that needed to be explained, and they did so during the earnings call. But the other one that was reporting results yesterday was Wipro. Are there any hopes of improvement going forward? At least the guidance seemed to suggest so.
Indeed. So in Q1, the company reported a -2% growth. The Q2 guidance is -1 to +1%. Now, assuming the company meets the middle of the guidance, we're talking about zero growth, which means it's a 200 basis points improvement in Q2 versus Q1. And typically, Wipro meets the guidance. They've roughly, on an average, achieved the midpoint. So that points to Q2 being better than Q1 by about 200 basis points. Then the company said that given the large deal wins in the pipeline, they're confident that H2 is going to be better than H1. And they also said that when asked that do you think FY26 will be better than FY25, he said, I think so. So it's possible, right? The second positive is, or which underpins this entire confidence, is the deal wins. Deal wins were very strong for the company. The deal wins came in at nearly $5 billion, $4.97 billion, up 24% quarter on quarter and up 50% on a year-on-year basis in constant currency terms. This also includes a lot of large deal wins. What the company said is that these deal wins, because they're in cost optimization or vendor consolidation, they're fiercely fought. They're competitive. So there is going to be pressure on pricing. There is going to be upfront investments which the company needs to make, but they are looking to offset that with operational rigor and excellence and all the levers that they have, and try and perhaps, in the past at least, they've spoken about maintaining margins in a tight band. They didn't say so this time, but we'll have to watch the way the margins go. But at least in terms of a top line, their priority is growth. Listen in to the management.
So there is this very strong deal momentum that we have had in Q1, which we tend to carry to Q2. Of course, some of these deals will take its own time before we start ramping up. Second half for us will definitely be better than the first half, especially because of the large deal bookings and the pipeline that we have at this point in time. What is very important for us to execute these large deals. And also the pipeline continues to stay strong for us. So that gives us the confidence that H2 will be better than H1.
For those deals to really translate into revenues, it will require upfront investments. There will be pressure on costs. You know that large deals typically come at lower margins, and there will be some pressures that we will have to offset. We will go back to that muscle of operational excellence that we will continue to drive. And those are the puts and takes on margins. We don't guide for margins, but we are happy with our performance in Q1, an 80 basis points improvement. And from there, we will take it. I think in Europe, we've had, for the last 4 quarters, we've not performed as well as we ought to have. It has been a combination of the macroeconomic environment, lower discretionary spends, but also certain client-specific issues that have played out. We believe we are very, very close to bottoming out. We have a large deal win that we have secured, and also some very good deals that we have also secured in Q1. Our pipeline is good, strong. So we are very, very hopeful of Europe bottoming out and coming back into performance starting second half.
We had given a wage hike last year in September. We haven't decided what's the plan now. We'll review it closer to the date based on the macro environment, demand situation, what's happening, and we'll take a call. So nothing, as soon as we decide, we'll let everybody know where we stand.
Okay, we'll slip into a break on that note. We'll come back and discuss what's buzzing in the commodity space. Manisha Gupta joins in on the other side.
Welcome back. Still 150 points lower on the index. Shifting focus now to the commodity side. Manisha is here to talk about cryptocurrencies, and Bitcoin is back near their all-time highs, just continues to move higher, does it, Manisha?
Well, it does. The way it has been going and the way we're looking at very positive news coming in from US clearly tells you that there is more support or steam left in case of cryptocurrencies there. So when you look at Bitcoin, well, yes, $120,000 is back onto this one. All-time high has been at around 123. So not too far away from those kind of levels. And if you've been tracking Bitcoin, you do know that it moves very fast when it comes to that. So in the last month, we've seen Bitcoin gain up by 15%. But it's not just about Bitcoin. If you look at the altcoins, Ethereum for that matter, is gained up by 44% in the same time. Well, let me tell you that there are at least 5 to 15,000 cryptos that are perhaps launched on a daily basis. And that's how they get lost as well. But it is 2,000 cryptos which are actually strong, active, have a very strong market capital as well. And within this as well, 50 is something that you will need to perhaps keep an eye on, follow, watch as well, if you were looking to invest in cryptos as well. But what I want to talk about today is, it's the crypto week right now, this one. And we have seen a lot of deliberations go through in the US ahead of that. And what we finally do understand is that the 3 laws have been passed by Senate onto this one. One is Genius. Remember, we've been talking about that. It is the guiding and establishing national innovation for US stablecoins. This is something that there has seen a lot of push come in as well. The second one is Clarity. Now, this is about establishing a stronger market structure, a friendlier one when it comes to many of those cryptos. And the third one is Anti-CBDC Surveillance State Act. What we also do understand is that Clarity is something that you could be looking at the US, rather, Genius is something as an act which the US president perhaps could sign on in today itself. And the other two, Clarity and Anti-CBDC bills, will go in for further discussions if there is an amendment or not, and then it would land into the White House for further signing as well. So it does seem to be moving pretty fast, and this is exactly what is giving a lot of comfort and support in sense of the pricing there.
Okay, makes sense. Thank you so much for explaining that to us, Manisha. That's about the crypto world. But it's a good time to get a technical check on the markets as well. Mitesh Thakkar is joining us now. Mitesh, we have broken that 25,000 mark. That's been the case for a while now, today at least. Can you explain what are the next levels to watch out for on the Nifty, seeing that sharp cut that we are seeing today, the lowest levels that we've seen in a month almost?
On the Nifty, I've been advocating a test of possibly 24,900. We got a low around 24,925. So in that sense, we have reduced our short exposure. I'm still looking out if this level of 24,900 holds. In case there's a reversal, then we'll cut an exit or shorts and even explore longs. But in case we start breaking below that, we'll get back into adding into short position. So that's the way we are approaching the index.
What about specific stocks, Mitesh?
Since we are believing that we are close to support levels, I have a buy on NMDC with a stop at about 69 for targets of around 74, and Oil India is another one to buy as well. Keep a stop just below levels of around 443 and for targets of 465.
Okay, thank you very much for that, Mitesh. We'll slip into a break. On the other side, Ravi Jhakar from All Cargo Group will join in to discuss their FY26 outlook and much more. Stay tuned.
Welcome back. You're still tuned into Trading Hour on CNBC-TV18. All Cargo Group is in focus on the back of its restructuring process, the recent capacity expansion in the group companies, and a lot more as well. To discuss this, we are now joined by Ravi Jhakar, the Director of Strategy and Group CFO of the group, joining in now. Mr. Jhakar, good morning. Thank you for joining in. Well, there have been a lot of updates with the group recently, but let me first speak to you about the capacity build-up and setting up of new container freight stations or ICDs as well. What kind of capacity expansion are you planning? What is the capex that you'll be putting in, and how will you fund that?
It's a pleasure to be on your show. Let me start with the all cargo terminals business. That's where we have all our container freight stations and ICDs. So primarily in that business, we are the largest CFS operator in the country, and the business has been doing good. We've been running close to full capacity across facilities across the country. What we intend to do is we intend to add capacity in JNPT, in Chennai, and we have been speaking about an ICD North, which is also now progressing well. The land acquisition part, which is in a group company, has been going on well too, and we would be in a position to start developments on that property within this year. So we believe that we can set up a couple of new CFSs and the ICD. In terms of funding, we believe there are multiple opportunities. To begin with, the board has recently approved an issuance of preferential allotment to the promoter group, which has been concluded and is now will be subject to the shareholders' approval. We would evaluate other opportunities for fundraise, but in that business, it's a very strong operating cash flow generating business. So we believe internal accruals will also pave way for the growth required in the coming years. But we see there's a strong opportunity for us to grow because with the addition of new facilities and new capacities, our constraints on growth will be removed and we can continue to outgrow the market on the CFS side. On the ICD side, it's almost like a new product for us. While we have a CFS in the Container Corporation joint venture that we have in Dadri, this would be a much larger standalone ICD that we're developing in NCR, in the heart of NCR industrial area. So we expect that it would still take about a couple of years to fully operationalize, but that's the long lead development in terms of setting up infrastructure and all the approvals, etc. But these are the key plans to expand capacity on both CFS and on the ICD side as well.
So you will be expanding capacity, but what will the capex number be?
So it would be a combination of asset light and asset heavy, in the sense that, we would try to get into some of the operating leases. Like in JNPT, we are looking at expanding capacity by almost 30% with the addition of new facility, but that will be on an asset light model. In Chennai, we are evaluating both models right now. In ICD, there'll be some capex required. So we estimate that the total capex requirement over the next 3 years could range anywhere from about 150-200 crores to about 350-400 crores, depending on the final dynamics of our strategy, whether we go asset light or asset heavy, because both options exist. But it would be a reasonable investment in terms of capacity and in terms of capex, also from the company's standpoint on all cargo terminals.
What will this mean for all cargo terminals' overall top line? I mean, you ended last year with a top line of about 750 crore rupees, and I think in Q4 there was a loss also. With so much capex coming on stream, in 3 years, what do you think your top line would look like, and what would it do to your margins? I mean, what's the big picture here?
Yeah, so I would say, with the new capacity addition, we believe that over the next 3 to 4 years, there should be an opportunity for the company to grow in the range of 15 to 20% kind of a compounded annual growth rate. That's the broad target around which it is being planned. And in terms of return on capital employed as well as for the new projects, these are all significantly higher than our weighted average cost of capital. So these all will be financially value accretive from that standpoint. And speaking of the performance on the operating cash flows, the operating cash flows have remained positive for last several quarters. There could have been, one-off depreciation line items that you are possibly referring to on goodwill depreciation or around the brand, etc., on some past acquisitions, which potentially leads to, a decline on the bottom line. But from a business standpoint, the operating cash flows have remained steady and consistently positive over last many quarters and will continue to remain positive and also grow from here on, because we don't see any negative, headwinds for the business.
Ravi, good morning. Thank you for joining in. You mentioned about all cargo terminals. Shifting to the logistics business then. Well, how has the quarter been? If you could tell us that first, the quarter that just ended in June. What are the trends that you are currently witnessing? And based on those trends, what are the kind of volumes that you're likely to deliver both on the full container load and the less than container load businesses for the full financial year? If you could share a number on that front.
So, like always, we'll have to refrain from material guidance on the numbers, but I can give you a flavor. We have been updating the numbers on a monthly basis. The June quarter has remained subdued on the international business. We have not seen any momentum until the June quarter. It is also very customary for May and June months to be low, and typically it's the month of July from which the trade pickup happens globally. This time, while there was a bit of a confusion around the tariffs and that led to a volatility within the months of April and May, now that we are into almost third week of July, we are seeing the momentum come in on the international trade like every year. And we believe that going by the trends of the first 3 weeks, what we have seen, and also some of the inquiries into the next couple of months, we believe we should see some momentum in terms of the international trade picking up over the next 3 to 4 months, which is the shipping cycle. On the domestic side, again, we have seen volumes picking up ahead of the festive season. So I would say April to June quarter, subdued on both domestic and the international business, and a good momentum from July onwards.
Got it. Thank you so much, Mr. Thakur, for joining in and telling us what's happening with the group overall. That's the word coming in from All Cargo Group. With that, we'll quickly take a look at what the markets are doing, because there's been that fall that we've been talking about. Still that cut on the Nifty below that 25,000 mark. It did see a recovery from those levels. So it's very close to that 25,000 mark. But nevertheless, we are seeing those cuts in the benchmark index as of now. From the Nifty pack, the movers, let's talk about that first up. HDFC Life, that stock is at the day's low. We also have Maruti Suzuki, which is putting some pressure. Though it is flat, it is still at the day's low as we speak. The Sun Pharma, Asian Paints, Titan. Reliance Industries is the other one. That stock remains in focus. We have the numbers coming in from Reliance Industries today. The company will be reporting numbers. It's post-market hours, but it is expected to be a good quarter for Reliance Industries. We'll discuss that in greater detail in just a bit. Wipro continues to do well. We had Tata Communications as well that spoke to us today. That stock is up around 2.5%. Delivery is the other one which is doing well in trade. That one is up around 1% right now. A lot of earnings reactions that we are looking at. For instance, Clean Science is down 7% as we speak. We have Nugent Software, which reported numbers yesterday during market hours. It was down around 6%. Additional 5% gone today in trade as we speak. So it's a very stock-specific market. The mid-caps continue to to see a bigger cut. The advanced decline ratio absolutely in favor of the declines right now. So we'll keep tracking market moves for you. There is a recovery, a swift recovery from the lows. We'll have to say whether we build onto that or not.
There's one more company, Root Mobile, and I think that's also slipping in trade. That's down nearly 4%. It's reacting to its numbers, and it was a weak set of numbers. The company's revenues declined both quarter-on-quarter and on a year-on-year basis. Root Mobile, this is a company which, it's a CPaaS provider. It basically, every time you make a transaction, for instance, you're buying something on Myntra or Flipkart, all the SMSs that happen between Flipkart, your bank, and you are routed via Root Mobile. They provide that platform and the service. And 10% decline in revenues quarter-on-quarter. Year-on-year revenues were down 5%. Margins came down to single digit. And the company said the international business is struggling. The domestic business is doing okay, but here the realizations are lower. And then the company also, terminated certain low margin kind of contracts. So that stock is down close to about 4%. Get into a break. On the other side, market fundamentals with Mukul Kochar from Investec Capital lined up. Welcome back. Let's now find out the big movers and shakers of the day. Hormus has now moved over to the big wall. Hormus?
There's been significant movement in the broader markets all through the week, even though if the index has been consolidating. But you start off with some of the top losers then, and there have been significant ones in reaction to news flow, in reaction to earnings. And Nugent Software is one of them, came out with results yesterday. And since then, the stock has been on a bit of a downtrend. The stock ended 6% lower yesterday. The results were weak. And in fact, the stock has now declined in 7 out of the last 8 weeks now. And the stock is now set for its worst weekly performance. This 10% drop is the worst week it has had since January of this year. A star of the earlier days, defense stocks continue to see profit booking. And take a look at this. Bharat Dynamics is down 9. Garden Reach down 7, Cochin Shipyard down 6% this week, and a lot of the other names too have seen losses of anywhere between 2 to 5%. You take a look at them individually. Bharat Dynamics, this 9% fall that we have seen is the worst that the stock would have had since July of 2024. So it shows the kind of moves that defense stocks have seen over the last 12 months. You take a look at Garden Reach as well, 7% lower this week. The last 4 weeks, 3 of them, the stock has ended lower. This Cochin Shipyard and Garden Reach, of course, down 6% this week, and that too is the 4th straight weekly loss, and from those levels it has declined 21% in the last 4 weeks. Some of the one other significant mover on the downside this week is Inox Wind, and in fact the stock had seen some very significant uptick in volumes over the course of this week, and the 2nd straight weekly loss, and this would be the worst week since March of 2025, this 7% loss that Inox Wind has had. Of course, there are some names that have bucked the trend, and Anand Rathi Wealth is among the top gainers this week, 20% higher for the stock. The 7th straight weekly advance for the stock. The results were strong, and since then it's continued to build on those gains, and this is turning out to be the best week that the stock has had since it listed in 2021. Some of the other movers, Newland Laboratories is the other one, 18% higher this week, and this is the best week that the stock has had since October of 2024. But despite this up move, the stock is still down 20% from its 52-week high, which was well above 18,000 rupees. The stock currently trading around 14,500. And so the other gainer that we have to talk about are the wires and cables companies. Both KEI Industries and RR Kabel have done well this week. RR Kabel, in fact, has gained all 5 days this week. This is the best week for RR Kabel since May this year. And for KEI Industries, it's the best week since the start of January. A big trigger, of course, Polycab's results that came out yesterday. The convincing beat on expectations, and now that has resulted in expectations going higher that the industry is likely to see a strong quarter this time around. So extremes on both sides. It's been a week to forget, you'd say, for the market so far.
Okay, all right. Interesting list there. Thank you so much for joining us, Harmis, with that top list of movers this week. With that, let's move on and get some fundamental conversation going. Mukul Kochar, the head equities at Investec Capital, is joining in now. Mukul, good morning. Thank you so much for joining in. You know, we have seen earnings downgrades in past couple of quarters. How long before we see a pause to that? What kind of growth are you expecting for Nifty this time around in FY26? And this is happening in a backdrop where we are also seeing rate cuts. So what do you make of that?
Yeah, so, broadly, if you look at the next 2 years and the next year also, we are expecting Nifty and BSE 500 to do roughly double digit, close to 10% sales growth. Net, we expect earnings to be 1 or 2% here or there of that. What you need to sort of take into account is that over the last 10 years, inflation in India has averaged roughly 5%. This inflation number is down below 3% today. So, of course, with lower inflation, you will have some impact on sales and earnings growth. It's natural, very natural to expect that. But the offsetting feature of that is that interest rates also are down because of lower inflation. And also another factor is that demand of money from the government itself is down. They've been consolidating their fiscal. So net, while adjusted for inflation, sales growth is actually the same or higher than the last 10 years. Interest rates are lower. Yeah. So this is something that's very important that investors should keep in mind. A lower nominal inflation, lower interest rates naturally imply that returns from markets will be lower, but adjusted for inflation, we think that the market will still give you, reasonable returns. Overall returns should be in line with sales and earnings growth, 10 to 12%. Given that interest rates are declining and deposit rates that clients get, which is the opportunity cost of capital, will also be lower. We think the market's actually priced for fairly reasonable return, and then investors should be actually investing today.
Mukul, I remember from our earlier conversations, you'd once spoken about how you're overweight financials, particularly large private sector banks. Was Axis Bank one of the companies that you liked, and what have you made of the negative surprise, this big jump in their provisions, the technical provisions? I mean, how should investors read this? Because the stock is down today, even if you don't own it or you're not recommended it. But tell us the thinking behind this as a investor.
So we are restricted from talking about individual stocks, but I'll give you some idea. Broadly, we expect the asset quality cycle in the banking sector to get better. Yeah. And that is because bank balance sheets are in an exceptional space. And we believe that unsecured stress that had built up in the system should also get better. In that, we are positioning some of the cheaper banks, which have not had a good run so far, as an investment case, that given that your overall environment is getting better, these some of the cheaper banks should outperform. Now, what happens in that is you do get quarterly sort of aberrations here and there. In some banks, naturally, we weren't expecting a surprise, but we did get one. But this is also a valuation call where you should see that some banks are trading, or the larger banks, maybe trading at a low enough valuation given where we think their sustainable ROA is going to be. Yeah. So in the large banks, while we have some consistent compounders, on one side, and on some of them we are taking a little bit more aggressive call based on valuation.
Mukul, good morning. Thank you for joining in. The wires and cable space is been in the spotlight after Polycab's results yesterday. Unlike the paints segment where competition has led to a bit of a valuation derating for the incumbents, here the incumbents are continuing to defy expectations and continuing to post strong numbers, as was evident from Polycab yesterday. Where do you see yourself in this space? Do you still continue to find value despite the increasing competition, or do you believe that the stocks are a little stretched as of now and you would wait for a better entry point?
So wires and cables, is a sector that's positioned very well for the infrastructure cycle. Specifically the power cycle in that infrastructure cycle. Even if you look at the internals of what the companies report, the strength actually comes from the cables business, which is heavily levered to the infrastructure cycle. The second part is even on the wire side, as electrification takes place, given that electricity itself is becoming a very sort of compelling proposition versus other sources of energy. As electrification increases, you have more demand for wires as well. But right now, the bigger demand is coming from the cable side, which is related to increasing electrification, increasing electric infrastructure. That is a trend we expect to continue, because electricity is used not just for electrification, let's say, of something that's very obvious, which is EV. A lot of wiring and cables is actually used in data centers, which is firmly in the center of what the next 10-year or 15-year theme is going to be, which is data analytics and AI. And this is a global trend. We did speak about FTA on your channel in the past. Within wires and cables, we expect exports also to do very well, especially if we sign some reasonable trade treaties.
Take that point. Mukul, while we are talking about some of these newer or bigger themes, renewables, for instance, India is going big on renewables. A lot of these PSU majors are being asked to put capex there. While the US is doing something opposite right now, there has been a sudden change in policy. Do you think renewable as a theme would give as much return to a business as the traditional energy gives? And what would it mean for the investors of these PSU companies, be it the oil and gas majors or power majors?
See, there's a slight bit of nuance there. So first of all, first part is adoption of renewable. There's very little doubt that adoption of renewable will be very strong because economics have started working. In the first stage, renewables have been adopted without a storage solution, but the next stage will be when the storage also becomes economical. And overall, time shift of demand can take place, time shift of supply, can take place, and that will be another leg for renewable. So we expect from the demand side and supply side, renewable to be a very firm trend because economics is on the side. For returns, from companies, there are many other factors, which is the level of competition that is going on, how companies are bidding for these contracts. And there, the picture is less clear. There could be a, situation of oversupply where returns for the companies involved in the supply chain are less. And there again, you have capital equipment suppliers, EPC suppliers, and power producers. On the power producer side, there's actually we see a little bit of compression in return, but, that is also acceptable given that what I said before, that interest rates themselves are lower. So power producers should be okay, but the rest of the supply chain will depend upon the level of competition. But renewables is a very, very firm trend globally based on economics.
Well put. Thank you, Mukul, for joining in. Just to quickly address the flashes which were there on the screen a while back, where sources are telling CNBC-TV18 that, on the rare earth magnet crisis, because it is deepening, and now we understand that the PMO is going to step in. He's going to hold a key meeting today to address the ongoing shortage, because so far, at least, there hasn't been a breakthrough, and the industry is clearly a bit worried, particularly, the auto industry has been a bit worried. So the PMO is now stepping in, and they will be holding a key meeting. And I think auto companies particularly have cautioned that, if this isn't resolved, there is a risk that production might just get impacted. Not today, but, we need a breakthrough or a resolution on this in the future. So that's what we picked up on, from our sources. And this meeting will be we'll wait for what comes out of this meeting very closely. Okay, let's get into a break then.
Yes, let's do that. While we do that, also remember to tune into the all-new CNBC TV18 Prime, bringing you insights from policymakers, business leaders and economists shaping both the world and India's future. CNBC TV18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune into CNBC TV18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C and Global Lens at 8:30 p.m. Welcome back. You're still tuned into Trading Hour. Well, from the broader markets, Clean Science Technology, that is one stock which is under pressure. The numbers on a YOY basis look decent. Quarter on quarter, there was a fall. So if you look at the YOY numbers, revenues were up 8%. There was a 5% growth in EBITDA. Margins came in at 41.7% and profits were up 6% as well. The company, its investor presentation indicated that they got 25% of their revenue contribution coming in from new launches, and the EBITDA margins also remained at that 41% mark. They have seen domestic market share gains. They have seen industry growth as well. However, it was the management commentary that has pushed the stock lower. One, they said that they're cautious on that 18 to 20% EBITDA growth guidance, which they had given earlier. It could be in the range of 15 to 18% now, but they are not sure yet. There will be clarity only after quarter two. They also said that they are upbeat on the second half, particularly fourth quarter of this fiscal. However, the cautious commentary on EBITDA growth is something that the street does not like. Secondly, three promoters and promoter group members are evaluating the possibility of sale or divestment of minority stake to support family estate or planning and management. So currently, the stake is around 74.97%, and after divestment, they say it will continue to remain above 50%. But there's an overhang that the street is watching out for, because there's no clarity when it will happen, how it will happen, who they will sell it to. So that promoter stake sale overhang is also pushing the stock lower. So weak commentary and that stake sale overhang has pushed the stock lower by 7.5% as we speak.
Indeed, not very good going for Clean Sciences. And remember, IPO price of around 900 rupees. So since then, the stock did move higher, but now in a bit of a correction mode from the 52-week high. The other positive earnings surprise that came about, though, was from Nuvoco Vistas, and that is resulted in a lot of other cement stocks also moving higher. You take a look at the numbers. Well, revenues were higher on a year-on-year basis, as was the operating profit. The bigger improvement, though, came in the margins. You take a look at the margins, it was almost a 500 basis point improvement that came in for the margins, which are almost at 18% now compared to 13% last year. And the profitability, of course, that was also a major improvement that was seen on a year-on-year basis. But the lot of this was also courtesy of lower finance costs. Finance costs, if you take a look at them, the power and fuel costs have remained almost constant. Other income, though, has improved, and that also contributed to better profitability. But it was the lower finance costs that contributed to the improvements in margins. And power and fuel costs, although they've remained stagnant, but they haven't gone higher, and that too is a positive. The other positive is the EBITDA per ton that the company reported. And if you take a look at that figure, almost 1,000 rupees plus now on the EBITDA per ton front, and that is compared to 700 rupees in the same quarter last year. And even on a sequential basis, there is an improvement, because it was at 968, so it was already heading towards that 1,000 rupee mark, and now it has crossed that 1,000 rupee mark this time around. And the other positive for the results was the decline in debt. And every time there is a reduction in debt, of course, the street takes it positively, as it has for Nuvoco Vistas as well. So from almost 4,400 crore in the previous quarter, the number has gone down to less than 3,500 crore. So it's almost a 900 crore debt reduction that you have seen this time around. And even on a year-on-year basis, that number is lower compared to the 3,640 crore in the base quarter. So overall, it was a strong performance from from Nuvoco Vistas. Better margins, debt coming down, the operating performance was strong. The street taking it well, 4.5% higher now on that stock. And that as a result of which Ultratech and some of the other names that report results over the weekend and going forward as well, they are doing fairly well for themselves, Reema.
The stock has hit a fresh 52-week high. The earlier one was in December, 385. But today, with this 13 rupee up move, Nuvoco is at a fresh high. Though in the last 5 years, the stock has declined by close to about 26%. But it's time now for a special segment, Quarter Se Quarter Tak. And we'll get you earnings expectations from each sector. And today, it's over to Mangalam now to give us a lowdown on the FMCG sector.
Previous quarter, I said the tagline for the sector was same, yet different, because things were looking like they're improving. And this time we go with green shoots are coming. Why do I say that? Because, if you look at it, in the recent times, the stock moves itself showcase that belief. In the month of July so far, the FMCG index has actually outperformed the Nifty by 5%. Even some stocks have rallied in double digits, some for specific reasons and some for good performance. So what's expected this time around? Good rural growth that continues. Urban, which was under pressure, is now seeing gradual improvement, signs of life out there as well. Raw material prices, while they are volatile, the worst seems to be behind them. And staples may outperform discretionary. That's the big headline this time around. Summer products, some of the categories did get impacted by unseasonal rains and strong competition across categories. But we have a peep into what a lot of these companies are likely to report this time around. Godrej Consumer's India business delivered high single-digit value growth driven by mid-single-digit volume growth. Marico said its underlying volume growth in India has been at a multi-quarter high, led by their value-added hair oil business, which grew in low double digits, telling you consumer sentiment has improved because this segment wasn't doing too well for them. Dabur too witnessed sequential recovery in demand with uptick in volume growth in both home and personal care and healthcare. Their beverages portfolio was impacted. There was growth in discretionary. You saw 31% for Kalyan Jewellers, Trent about 20%, 18% for Titan, and V-Mart Retail for 13%. But these stocks actually saw a decline despite optically strong performance coming in the top line. Why? Because the pace of growth slowed down and valuations, they're catching up. So staples doing better than discretionary. Among all the companies that are likely to report numbers this time around, we expect some weakness to continue for Asian Paints, even as the environment for the paint sector is improving. HUL, Tata Consumer, Britannia, all of them likely to show incremental improvement. The one particular stock I'll be watching out for this time around, United Breweries, 10 to 12% revenue growth expected. Bears a summer product. The company has increased its focus on premium offerings with all the regulatory navigation that it has to do. That will be important to track. For the entire sector, speaking about strategy, the most important thing will be strategy of new leaders. We have a bevy of new leaders at HUL, Nestle, Pidilite, Titan, Bajaj Consumer, and many more. Further improvement in urban consumption will grow. And finally, scaling up of the recent acquisitions, for instance, HUL having bought Minimalist, etc. And finally, the valuations, all of them pretty close to or slightly below their 5-year average, even after the outperformance that we've seen in July.
Mangalam, thank you for that comprehensive wrap-up of what to anticipate in the FMCG space. You take a short break, you put the spotlight on some of the key expectations from the big boy, Reliance Industries, that reports results later this evening. Stay tuned.
Welcome back. You're still tuned into Trading Hour. Well, the big boy Reliance Industries set to report its numbers post-market hours today. Remember, the stock is already up 21% this year so far, trades at 23 times FY27 EPS. In terms of numbers, expecting a good set on a sequential basis this time. Revenues, yes, they will decline 8%. That's because raw material prices, some of the raw materials, the prices were lower this time. EBITDA, however, expected to grow by 3% to come in at 44,965 crore rupees. Margins at 18.7%. And profits are expected to increase by 16% to come in at 22,024 crore rupees. Now, what are the internals? What will they look like? Oil to chemicals, geo and retail. All three of them will perform very well this time. However, some pressure will be seen in the oil and gas business this time because of lower production. So O2C, that's where the expectation is that it will increase 19% YOY in terms of EBITDA, 3.5% on a sequential basis as well. However, there was a shutdown that the company took in the quarter gone by. Geo ARPU expected to increase 1% on a sequential basis, and retail business, the EBITDA is expected to see an expansion on the back of JioMart scale-up, operating leverage and increasing footfalls as well. So their EBITDA that has been consistently increasing will see a further increase this time, 44,965 crore rupees, which will be at a 5-quarter high. So that is what we're expecting from Reliance today.
Interesting. Keep an eye out on the Nifty Big Boy. Earlier numbers out this evening. We take a leave on this edition of A Trading Hour. Leave you with the Nifty at 24,950 from Reema, Sonal, me and the team that put this show together. Thank you so much for watching. Halftime report on the other side.